So I'm going to talk about City London Investment Trust. I'll set the scene and talk about some of the sort of advantages it has as an investment trust. Also talk about performance and how the portfolio is currently positioned, how I'm seeing the outlook. So move on to the first slide. So that picture is actually of the brewery that City of London originally was. It closed down in the 1930s. It was on the River Thames and turned itself into an investment trust at that stage. Our objective is to grow investors' capital over the long term, both income and capital. And I think one very important feature of investment trust I always mention is independent board of directors. It's always been a big feature of City of London. Our chairman is Sir Laurie Magnus, who's got a long career as a corporate financier and is been our chairman since October 2020. He's also ethics advisor to the Prime Minister. He started doing that up under Rishi Sunak and has carried on with Keir Starmer. We have about 2.13 billion of assets at the end of December, which is the biggest trust in the UK equity sector, and we've been very popular over the years. Issued a lot of shares at a small premium to NAV, which means it enhances the NAV for existing shareholders. But we've also buy back at a tight discount to NAV, and you would have seen this year we bought back some £8 million worth of shares at a discount between 2 to 3% or close to our NAV. So we try to reduce the share price volatility. Next slide, please. I've been manager for a long time, since 1991. It's been a huge privilege. I can't think of anything better done for me. I've worked with David Smith for over 10 years, and he was appointed deputy 3.5 years ago. One of the functions of the independent boards, we've got a very competitive management fee. It's only 0.3% of net assets, and our ongoing charge is the lowest in our sector. And another feature of investment trusts is that you can take out long-term debt. And when interest rates were very low, we took out some very cheap long-term debt. So we're borrowing only 2.67% out to 2046 and at 2.94% out to 2049. And those borrowings will secure cheap financing for our shareholders for the next quarter of a century. Next slide. David and I work in the global equity income team at Janus Henderson, and you'll know some of my colleagues, but we're investing both in the UK and globally. And it's obviously very important to have that global perspective as well as focusing on the UK. Next slide. So Janus Henderson was formed as the merger between Henderson, which was founded in 1934, and Janus, which is an American company, and we merged in about 2017, and it's worked very well. And particularly Janus, having that greater understanding of the US market, which has brought us, has been very useful. And also they've got some very strong analysts, and we're well known as having exceptionally good analysts, almost an academic level of understanding the companies, and obviously that's been very helpful. Next slide. So just to recap on some of the benefits of the investment trust, there's revenue reserves. That's one of the levers we have for consistent dividend growth, and I'll talk a bit more about that in a minute. We can issue shares and buy them back, and we've already mentioned that. And then we've got the gearing, the cheap long-term gearing, which I've already talked about. Next slide. So in terms of my investment philosophy, it's valuation driven. So what's critical for me is share price valuation, and whether it's reflecting the future prospects of a company, or if it's overvalued, then you might want to be taking profits. And so we start with dividend yield. We look at a range of factors, and we've got to be in companies that can grow their profits and grow their dividends and are investing enough for the long term. We don't want to be in the high yield value traps which end up cutting their dividends. And the other aspect is it's a very conservative approach, and we like companies that are generate a lot of cash. They're best able to support their dividends and invest enough for the future. And we like strong balance sheets, especially for cyclical companies. So we're looking at the downside risk as much as the upside potential. Next slide. So a good example of this is one of my favorite companies. It's in the top 5 of our investments. Relics, you may not be a very familiar company. It's one of the best companies in the FTSE 100. It provides information analytics for a range of businesses. I mean, it's used by 21 of the top 25 insurers, for example, 9 out of the top 10 banks, and it's providing them with essential information and analytics, or they can, underwrite their, price their underwriting, for example, or do identification and verification. So it's also number 2 globally in providing analytics and information to legal firms, and it's already using artificial intelligence in that division, and it's also the leader in providing information and journals to scientists and researchers. So it's a very strong company, and this is a UK listed share, but you can see 58% of its sales in North America, 21% in Europe and UK, and the rest of the world is 21%. So just because you're investing in the UK doesn't mean you're investing in the UK economy. You're often investing in very global businesses. Next slide. So carry on, next slide. So this chart shows you the long-term performance since I became manager in 1991. As you can see, we're well ahead of the index over the full 33 years. Actually, some of our best performance has been in relative performance, been in periods of down markets. But overall, we are comfortably ahead, and we're also ahead at the end of December. We're ahead over 1, 3, 5, and 10 years against the benchmark index. Next slide. So this looks back at 2024, just to get a feel for sort of where the performance has been achieved in the year when we were ahead of the index. And at the beginning of 2024, we actually moved overweight in the bank sector for the first time since the financial crisis. And the reason for this is that the balances that banks have in the UK banks they hedge their balances on a sort of 5 to 7 year basis, and these hedges they took out during periods of low interest rates. As they come up, they can re-hedge them at much more attractive interest rates, and that's been a very positive tailwind for the sector. And so NatWest was a stock we doubled our holding in, and it's actually performed exceptionally well, as well as producing a big dividend increase. So that's been, so banks and NatWest were the biggest single positive. We like the tobacco sector for its consistent dividend and profits growth, and Imperial Brands has taken advantage. I mean, a lot of people, it's a very unpopular sector for obvious reasons, but the shares were very, very cheap, and Imperial Brands has been buying back its own shares at a prodigious rate. It's bought back around 12% of its share count, and that's been very enhancing. At the same time, they can grow the dividend, and the dividend will cost less because the share count's down. 3i Group's an investment company in private companies. It's had a huge success with a discount retailer called Action in Europe, and 3i we've actually reduced a bit in the second half of the year, but it's done very well. And then Tesco's and IG Group, the next biggest stock contributors. In terms of the areas which have detracted from performance, unfortunately, I haven't held Rolls-Royce, which until the latest result hasn't been paying a dividend, so I can possibly be excused for that. But it's had a very big recovery, having obviously had a difficult period before that. Nestle is a big Swiss food manufacturing company. It's done very well over the years, but had a less good 2024. And then Schroders, Total Energies, the oil company, and Land Securities, the UK property company, with the other big detractors. Next slide. In terms of, I won't go through this in any detail, but this just shows the new buys and complete sells over the 12 months, and just to highlight Aviva, which is a insurance company made up of Commercial Union, General Accident, Norwich Union combined many years ago. And it's had a difficult kind of 20-year period, but actually under new management, they've sold off peripheral territories, and they're focused on the UK and Canada, and they're putting together a much better performance. So we're very encouraged by that. And BT, we've bought back into where they're building out fibre, but that capex peaks in 2027. We think the cash flow will be very good following that. And we actually, in terms of the disposals, we've had a few takeovers in the portfolio, and DS Smith and Wincanton were two stocks that got taken over. We've also reduced some of our overseas listed companies, such as Orange, in favour of BT, given the greater valuation, cheaper valuation in the UK. And we had a difficult period. A couple of retailers, so Burberry ended up suspending its dividend, as DFS Furniture, and we sold those two. Next slide. So moving on to the revenue, we've obviously got the longest record of consistent dividend increases of any investment trust going back 58 years. And we've made use of the investment trust structure because basically with investment trusts, you can hold back some of the income in a year, up to 15% of the income you receive, and put that into revenue reserve. And then you use that in the years when you get dividend cuts in the market. And if you go back to 2020, Obviously, that was the beginning of COVID with that lockdown, where a lot of dividend cuts in the UK market. I think FTSE 100 dividends were down by 36% that year. And so we dug into our reserves. You can see we paid out 21% more than we earned. The following year, we still had to pay out 11.8% more than we earned. But then the last 3 years, we've covered our dividends. So we carried on growing our dividend throughout this period. And so it's a mixture of being in consistent companies and the investment trust structure, which allowed us to consistently grow our dividend. Next slide. So that chart just shows you the 58 years of dividend increases going back to 1966. And I talked about being conservative trust. Well, this just shows you how the income is spread through different sectors of the economy. So we don't have too much in any one area, as you can see. And I think that's really akin to not having all your eggs in one basket. And I think that does protect us. Next slide. Next slide. So now I'll talk a bit about how I'm seeing the economic and outlook for the stock market. I think UK interest rates are on a downward path, given the growth is so slow. I mean, the economy actually contracted by 0.1% in January, and certainly the some of the measures taken in the October budget have not been helpful for the growth, with the employers' national insurance increase, for example. And in addition, obviously, the tariffs now getting from the US are very unhelpful as well. So I think it's a difficult period for growth, but unfortunately, wage growth is quite sticky in the UK. The national minimum wage was increased by 6.5%, and that has a ripple effect through the wage structure. And so inflation is actually beginning to increase again to it's hit 3% and probably peak at 3.5% this year. So I think interest rates are falling, but it's going to be I think that it's going to be maybe 1 or 2 cuts this year, no more. Growth, has been better in the US, but the US economy is also sort of the uncertainty caused by the new administration's policies that having an effect on confidence in the US as well. So I think it's quite a tricky period out there for growth generally. But I would say investors in UK equities are paid to hold on. There's terrific value there in terms of, and I got 2 charts. The first one is the price earnings ratio of the market, which compares share price with the sort of profit per share, and that's actually in touch with the long-term average over going back to 2002. As you can see, it's kind of right on the long-term average. But looking at yields, so for a long period, fixed interest yielded less than equities. I got a chart here of the dividend yield, the market, and 10 and 30-year gilts in the UK base rate. Now equities yield less than fixed interest, but I think this is really returns what it was for most of my career, because basically dividends grow, and so you would expect equity yields to be less than fixed interest. So I'm still comfortable with this relationship, and it was only a function of ultra low interest rates that the equities yielded more, which was sort of abnormal phase in my opinion. But I think the real evidence of the value in UK equities, the number of takeovers we've had. I mentioned Wincanton, GS Smith, and we've also had Britvic more recently, and Dowlais, auto component stock. And that's just to mention some of the takeovers. I mean, been a load more across the stock market, and foreign companies and private equity firms taking advantage of cheap valuations. So I think, given an attractive dividend yield, I'll definitely pay to hold on in UK equities. Next slide. So this is just gives you a sort of characteristics of the portfolio. We are predominantly in large cap stocks, mainly in the FTSE 100, always will be. We do have some overseas listed companies, but we've reduced that. We were up at 17% 3 years ago, and now down to 9%, given the greater value in the UK stock market. The biggest sector weighting at the moment is banks, as I've talked a bit about that, and then what's called technically investment banking brokerage. I mean, it really means financial services. The biggest holding there is M&G, which is a mixture of life assurance fund manager. Then we like the sort of personal care, drug and grocery stores. That's Unilever. Tesco's is also in that sector. Oil's our 4th biggest sector, with Shell our biggest holding there, and then pharmaceuticals is our 5th biggest, with AstraZeneca being our biggest weight there. So those 5 big sectors are, make about 44%, but so it's still a reasonable spread, and reasonable diversity between them. Next slide. So coming back to a point I sort of made earlier, but when you're investing in the UK stock market, you're not investing in the UK economy, and we can drill down to what the underlying sales of the companies in our portfolio, and some 63% come from outside the UK, mixed spread all over North America, Europe, Asia Pacific, and emerging markets. Only 7% of the underlying sales is actually from the UK. Next slide. So the top 10 holdings, you can see there are 2 banks in the top 10, HSBC and NatWest, and 4 consumer staple stocks. These are steady kind of multinational companies, very dependable profits and dividend growth: Unilever, Bats, Imperial Brands, and Tesco's. BAE Systems, our leading defence company, was our biggest holding in June. I took a few profits in the 4th quarter of last year, but they've had another big move this year, and I think it's now our 3rd biggest holding, just by going up. And it's a very good company, and I'm certainly very, very keen holder of it. And it's I think that we've had the end of the Cold War peace dividend, and BAE Systems is very much needed at the moment. Next slide. This shows you the next 10 down. You've got our biggest utility, National Grid, our biggest miner, Rio Tinto, and Diageo, the famous alcohol beverage company, and Land Security is our biggest real estate investment trust. Final slide. So 58 years of annual dividend increases, the longest of any investment trust. We use the investment trust structure. We do pay it out of income. We don't believe in paying out of capital. That may work in rising markets, but aggravates your losses in a downturn. So we earn our dividend, and but we make use of our revenue reserves in difficult markets for income. The ongoing charge is only 0.37%, which is the lowest of in our sector, and one of the lowest across in the whole investment trust sector. And we've achieved long-term outperformance of the index through conservative investment style. Thank you very much for listening. I'm very happy to take questions.
Joe, thank you very much indeed. I'll just get the questions up on my screen. And whilst I'm doing that, just a quick question from me. You talked about the M&A you've seen in the portfolio. Do you see that trend continuing?
Absolutely. I think it will continue. I think the UK is still looking very cheap relative to other stock markets on a range of value. It's got the best dividend yield, but there's a whole range of valuation metrics. I mean, I'm not suggesting that we just take a couple. I'm not suggesting a minute Shell's going to be taken over, but Shell's on a discount on various valuation between 1/3 and 40% compared to Exxon and Chevron in the US, for example. I mean, that's just one example. BA Tobacco is on a big discount compared to Philip Morris, and so on and so forth. I mean, it is. I think why is this the case? I think it's partly because we've all gone global in the UK. I mean, first of all, institutions have taken a very risk-averse stance, and I think the new government is kind of thinking about that a bit. But they've gone heavily into fixed interests. They de-risk their portfolios, and I think a lot of other investors have gone very global, and as a result, we are. There hasn't been a marginal buyer. But I think what's so interesting is that companies have now are buying back shares, and actually some 2% of the market cap of the FTSE is now share buybacks. So previously there used to be more share buybacks in America, but actually the UK is now buying back more of its shares than the US is. So you've got 3.8% dividend yield on the market plus 2% of share buyback, which is getting close to 6%. It's a pretty attractive distribution yield, and it's worked very well in the case of stocks like Imperial Brands.
On buybacks, I had a question here. When you do buybacks, how is that funded? Is it from revenue reserves or debt, or from other sources?
Yes, so share buybacks, technically they come from realized capital gains, net realized capital distributable capital reserve, which is net realized capital gains, net of any losses, which are very substantial. But essentially, we can choose to fund it by selling something in the portfolio, or we can let the gearing move up a bit. But obviously, they're pretty. Share buybacks we've done have been pretty marginal. Like this year, we've done £8 million worth with 2.1 billion in net assets. It's not really touched the sides, to be honest.
Okay. Next question is about supermarket price wars. How do you think that might affect Tesco?
Well, that's a good question, because Asda have just announced that I mean, Tesco and Sainsbury's have been winning share from Asda, and so Asda are now saying they're going to launch something of a price war. I mean, Tesco is a phenomenally strong company. It's it's got about 29% of the UK food retail market, and what I think its secret weapon is the club card, which I think about 80% of its customers use, and they have a huge amount of information about their customers as a result, and they can target their offers, and they're the biggest. They can get the best terms from the suppliers and the food manufacturers. So I think it's an immensely strong company. have to say, obviously, it's not great news because it's at the margin it will affect them. The shares have reacted negatively, but they performed very well up to this point. And I think I'm very happy to stick with it for long term, although it's obviously short term not great news.
Next question, another one about a company. How important is your holding in Phoenix? I think it's in your top 20. And what's the outlook for Phoenix?
Well, actually, Phoenix had very good results on Monday, and we actually got a meeting with the management team tomorrow. So if I could talk to you tomorrow evening, I'd probably be better informed. But no, I think Phoenix is it's ambitious to be the biggest life and savings company in the UK, and it's a mixture of closed life insurance books which they bought, which are kind of not open to new business, and also they bought the standard life business, and they're very big in the auto enrollment side. So it's a very strong business they put together, and I think they convincingly showed that the dividend was covered by cash generation, and they got a very convincing plan to bring down their leverage a bit. So I think it's a sort of misunderstood stock. I think life insurance companies are disliked by the market. They're seen as sort of black boxes, and but the results season so far has been pretty good, and we've had Legal & General had good results as well, and the other one I got was M&G, which I think they actually report tomorrow. So we'll see how they do. But I think these companies, I mean, it wasn't helpful. They had a change of accounting standard, which they were complicated in the first place, and then that threw everybody, I think. But I've been sticking with them, and I haven't been let down. The dividends, they've carried on growing their dividends, and the yields look they look very attractive on a yield basis. And if at some point they did re-rate, you'd get very attractive returns as a result.
Next question: is there any appetite to take on any fixed income while rates are higher than equities?
Not really. I mean, we in the distant past we have held fixed interest, but I think I think fixed interest is a kind of level that's kind of more sensible now, having been at previously a kind of point of kind of it felt like kind of return-free risk to me when it was really low, but it was very low for a long period. But it's the yields rather. But I think I think maybe we see so much more value in equities where you get growing dividends, and particularly in UK equities. So we're not attracted to fixed interest at the moment for us. But obviously people as part of their portfolios might want to take a different view, as including a mixture of things.
The question here, which is, I guess, the opposite of the M&A, are you not concerned over the FTSE losing its constituent members either through takeovers or companies relisting abroad? How could that affect the long-term performance of the trust?
Yes, I think at the moment we still see a fair amount of diversity in the FTSE. I mean, we don't see it being an issue at the moment. I mean, some of the companies that have relisted, we had Ferguson, which is like a building merchants company. We did originally have operations in Europe, UK, but it became 100% North American, US and Canada, and so it was kind of natural for it to relist, and it actually had a very good re-rating, and we sold the shares after after the re-rating. So I think some of these companies can more naturally end up in the US, but I think overall I'm still finding there's plenty of opportunities in the UK. I mean, to be honest, if we got to a stage where there wasn't, then we would be able to move more heavily overseas, but it's not something on the agenda or be contemplated at the moment. We don't see any need to do that.
Okay, one final question. You spoke about your holdings in NatWest and your exposure to banking and financials, traditionally beneficiaries of higher interest rates, but you also commented you thought interest rates might be on the decline. Can you talk to that?
Yes, I think interest rates are. I think they're going to decline, but not sort of like they're not going to go back to the sort of near zero we had. I mean, I think ultimate destination might be kind of 4%, that type of level. So I'm not seeing. I think we're in a kind of more normal interest rate environment like we had pre-financial crisis. To me, I don't think those ultra low interest rates have gone away. So I think the banks can operate. I mean, it's much easier for them to operate in a sort of more normal interest rate environment. Much easier to price their deposits, etc. So. I'm not concerned. I should say I think the capital and banks are always risky because they're leveraged. But having said that, the capital base is much more conservative than it was going back, and I think the banks are managing themselves well. And I think that it's very difficult in the UK for other people to sort of compete in banking. I mean, both Tesco's and Sainsbury's, which are pretty big, have pulled out of banking. They've sold their Tesco's Inc. sold their business to Barclays, and I can't remember who's saying to me, sold one of the big ones. And I think it's just, these companies. I think Chase is the only one of the alternative ones that is a viable contender, but they don't seem to have ambitions to grow that particularly big. But so I think there's an old joke that it's true actually, in banking you're more likely to get divorced and move your current account in the UK. So I'll leave you on that note.
And on that note, thank you very much indeed. Thank you for joining us this evening.
A pleasure.